Franchise Secrets, Eric Von Horn.
Hey, Franchise Secrets. Today I talk with our guest, Edith Wiseman of FRANdata. I've been wanting to get her on for a while. Finally got her on. We talked about some of her top takeaways from attending this conference called Springboard. We were both out there talking to a lot of private equity folks, investment bankers, franchisors, some franchisees, but there's some interesting observations on the mix of private equity that were there and how she sees that impacting franchising in some emerging brands. I also said, like, how would you investigate a franchise? What would you buy and why would you buy it today? We talked a lot about some of these. She works with a marketing research firm. And so they kind of have all kinds of data and access to data. And so, like, what do you do with that data? As a franchisee, what do you do with it? As a franchisor, what do you do with that type of data? Even as a buyer. So buyers, we got into things that you're not going to hear anywhere else on the things that you should be doing before you buy. And emerging brands, as usual, I love you, emerging brands. We love working with you at Front Street Equity Partners. And so I think you're going to find this one super helpful. Edith, welcome to the show.
Hi, Eric. How you doing?
We met face-to-face about a week ago at Springboard, and you just let me have it. Like, you came in hard after me, and I felt so bad. Do you want to share that story?
Yes. Eric had asked Daryl to be on his podcast, Daryl Johnson, the CEO of FRANdata. And our marketing director knows how much I love your podcast. And so she suggested to Daryl, why don't you have Edith on the podcast? And so Daryl made that suggestion and Eric said, no.
And I couldn't backtrack that either, because there's probably email or text proof of me actually saying that.
I wrote back and said, what? I love his podcast. How does he not want me?
The funny thing about it, and I told you this then, but it's absolutely true. And I told other people that you were coming on, they're like, Edith is the best. Like, you need to have her on. And I told you that. I don't know how much you believe me, but it's absolutely true. So I needed to have Daryl on because it was just before the IFA. I released it at the IFA when he was one of the keynotes there. So good to have you on. We just met. I've known about you. I've ignored you on the podcast before. We had a great conversation and got to know each other really well in a short period of time that evening with some mutual friends. So really is good to have you on. I love what you guys are doing over at FRANdata. And why don't you've been in franchising for 24 years. I know it probably, that's a big number. It's a big number for me too. I can't believe it. We were just talking about that. So why don't you kind of give people a little bit of your background?
Sure. Yeah. Not only have I been in franchising for 24 years, I've been at FRANdata for 24 years. And it all started when I answered an ad in the newspaper for a job right after college. I had bills that I couldn't pay for, so I needed income. And of course, what do you know what to do when you graduate from college is that you know how to research. So I started out as basically a glorified data entry specialist. And this is during like the .com era. And at the time, FRANdata had received an infusion of capital from a equity firm, from a venture capitalist. So it was quite a wild ride. They were hiring lots of senior executives, paying high dollar amounts. And I was basically plucked out of research by the head of business development who had helped take career builders to their IPO. And he gave me a sales job. And he told me later that he was planning on firing me because he didn't think I could hack it. Little did he know that 24 years later. So, but, you know, at the time, the company was really interesting. There were lots of like mini scandals because it, as probably a lot of .com companies were, you know, Office romances. The IT director actually broke into the email account of one of his employees because he had a crush on her and she was having a relationship with someone else.
Oh my
The guy
God.
got
Office
fired.
scandals.
Yes.
Oh my gosh.
Yes. Guy got fired during his honeymoon. I mean, it was a wild ride. But the point was, though, at the same time, we were working so hard, and then bust happened. And Silicon Valley Bank called on the loan. The venture capitalists basically wanted to get rid of as many assets as they could. And so everyone was fired except for 4 of us.
Wow.
So it was truly a wild ride. There was a guy at the time, GE Franchise Finance was one of our customers, and he offered to come to DC, to fly from Phoenix, to come to DC, to pay me personally $15,000 so I could hand him a disk with all of the data.
Oh my
Thankfully,
God.
While I was like 22, I was not stupid. So, yeah. So then the company got sold to National Cooperative Bank, which is where I started working for Daryl. And I really give him credit. He wanted to retain me out of the 3 people that NCB took on. And he put me through their executive leadership program and got me out into the field. And, I'd say that became more like the company has gone through 3 transitions. First started by an entrepreneur, then owned by a very conservative bank, and then kind of more of a stable kind of entrepreneurship from the third ownership. So I feel like I've worked for 3 different companies. And yeah, so since then, I've helped with all the product development because we're very close to our customers, and helped grow the lender vertical from 0 customers to now half of all SBA loans are underwritten with a fund report supporting them. So pretty substantial impact in franchising.
So you just
it's been a great ride.
You work with the IFA a fair amount, I believe, and you guys just released a report. What's the name of that report? How important is it? And what goes into creating it?
So we do a couple of reports for the IFA. One is the economic forecast that comes out at the beginning of the year, usually around the IFA conference. And that is extremely important because people are planning their budgets and really trying to understand, what is this next year going to look like? And what it's going to look like by industry. The inflation study that we just released is getting a pulse from 1,300 franchisees who talked about how inflation is affecting their business. And it's very important from a couple standpoints. First of all, IFA uses many of these tools to speak to legislators about the challenges that franchise businesses face, but it's also helping to communicate with the franchise or audience and franchisees generally that what are the tools that they're using to combat inflation. So one thing that I thought was super interesting was that smaller franchisees are less likely to raise prices than very large, sophisticated franchisees. And, that is something that franchisors should be counseling, spending more time with those smaller franchisees to say it's okay to raise your prices. Like, you are more scared than larger operators. And here's the data to show that.
That's interesting. I remember being in the tax business 20-something years ago, and we started to spend some time around that topic, charging more, and we'd say charge more and be worth it. Like, create value. There's got to be value in your pricing, but you raise your prices enough. You want some customers to leave because of price, but you don't want all of your customers to leave because of price. And then you start to have greater margin. And I was talking, and that was in the tax business 20 years ago. I was talking to somebody that's with Orange Theory yesterday on the phone, and he was saying how they raise their prices a couple tiers in their system. It's tiered pricing, and a bigger private equity group owns the majority of studios in their market area. And said they came in and said, we are raising all of these prices. And he was resistant to it in general, but they raised prices, and one studio is kind of flat. One is just gangbusters, raised it a lot, and that studio is overflowing. They cannot have any more customers in that particular Orange Theory Fitness studio. But it was if it was just up to him, a small operator, he wouldn't have raised prices. But because somebody else is coming in that is looking at probably a bigger picture, said we're raising prices and this is why. It's probably not always the best thing to do it just a blanket raise, but you have to kind of make some of those decisions. And his point in all of that was somebody has to make a decision, and they're looking at different data and things differently than I am as a smaller unit operator. So any thoughts around that?
Yes, that was absolutely the same conclusion that the study came to, is that it was like 99% of operators with 20 units or more all raised their prices. So basically every single operator that has 20 units or more raised their prices, whereas it was closer to the 80% for single unit operators. So clearly there's a less level of sophistication or access to data because you only have one location or two locations.
What else? What else in that study? How do people find that study? I put it in the Secrets Facebook group, and I put it in some of my private masterminds. How do people find that study, and how do they get in the loop on future studies and surveys that you guys put out?
Yeah, thank you for that, because what's really important to the success of any of these studies is actually having franchisees tell us what they're experiencing. So we got a 30% increase in respondents this year over last year. So it was 1,000 respondents last year and 1,300 this year. But yeah, all you have to do is Google search 2023 IFA inflation study FRANdata, and it will come up. And you could actually look at 2022. It's a longitudinal study that we do every single year.
The other thing you could do is go to Franchise Secrets Facebook group at franchisesecretsgroup.com, and we post cool stuff like that in there. But no, I love it when these surveys and whatnot come out, because I know what goes into creating that. How many hours goes into creating something like that? Like what's the lift into compiling all of that information?
I actually looked at this the other day, and I want to say that it's probably, so there's the recruitment end. So we have a database of franchise owners and their email addresses. We call them franchisee playbooks. So we're that's a constant work effort to get as many as possible there, so that when we actually go out to franchisees, we can reach them directly. And then we're crafting the actual survey and then compiling the results. So it's really hard to say on the franchisee information collection side, but I'd say probably about 50 to 60 hours, like almost basically 2 weeks of full-time work.
All right. I want to get into how franchise or FRANdata helps franchisees, franchisors, and franchise buyers, like how each of those subgroups can utilize FRANdata. But before we get to that, let's talk about Springboard. We were just there. It's one of my favorite conferences. Lane Fisher, Brad Fishman put it on, and it's just, they had like a 30% increase this year, something like that. It was really, really good. You were on a panel, I was on a panel, and it was just a really good time. There's always things that come away there for us. We're always looking at new brands over at Front Street Equity Partners. We're like, oh, what is this brand? Then we meet with private equity groups, investment bankers, like, what are you seeing in the industry? Why are you seeing this? What do you see as trends coming up? What are trends that are not so interesting anymore? Because whenever we're looking at getting into brands, we want a brand that we can take from worth very little money, because it's just starting as an emerging brand, to being worth a lot of money, $50 million, $100 million in 3 to 5 years. So there's that's what we kind of look for. So we're always looking down the road. You guys are probably looking much further down the road than somebody like us are looking. But those are some interesting conversations that we had. What takeaways or interesting conversations did you have at Springboard?
So before I even went, my observation was, wow, there is a lot of private equity and investment bankers and franchise sales organizations that are at this conference than other conferences. I was just shocked at the sheer kind of names that were there. And I think when I got there, it kind of there are two things that came to mind. Like on the practical side, I think the reason why they're there is because many of these firms that don't deal with essentially very new brands, like most of the brands there are pretty new, some not even franchising, but they're trying to basically create relationships with brands in their super early life cycle so that when they actually have something of value, that they already have a relationship. But I think it also demonstrates the fact that there aren't many opportunities to buy at the larger size that aren't overly expensive, that are just priced really high. But I think that the other thing that I kind of took away from that was I do think that we're in a new era where franchisors who are coming to market are brought to believe that growth needs to be fast. And not only does growth need to be fast, but then there needs to be an exit that is also fast. So I feel like that there's kind of unrealistic expectations that franchisors are being taught at this early stage. I was listening to one of your podcasts because, as I said, I love it, with one of the gentlemen who was talking about franchisee associations. And he said, the number one currency in a franchise system is trust. And, the challenge that I see with this kind of way of thinking is that if you're growing really quickly, you're basically skipping the steps to building trust. I mean, growth is not bad. I'm not saying that, but this expectation of fast growth and sale is that the underpinnings, the foundation of the relationship that you need to create with franchisees, I'm afraid might get shortcut.
So
that was my big picture observation.
No, that's good. So, and you had some of that formed even before you went, and then you had conversations that we have these conversations with brands that do have unrealistic expectations. And then there's always these success stories or perceived success stories of big growth, big sale, big money, big exit, unhappy franchisees, and people don't talk about the unhappy franchisees at the end of that rainbow because they just look at everything that was before that. So how does a brand grow fast, grow smart, and retain and build that trust with franchisees so when there is an exit, it's a healthy brand going from the original founders to the private equity company?
So that's a really big question. I don't know that I have a magic answer, but I do think that there was a group that I met there that I thought was interesting. They're franchisees that have that they are trying to share in the growth equity that the franchisor will be realizing should they sell. So this, I thought it's an interesting model because it says that we as franchisees, we inherently will be trusting you because we will benefit in the end should this go to an exit. So what I also was impressed with, I should say, is that because franchising is, I'd say, in their next kind of generation, you've got a generation of franchisees that were successful in franchising and now they're finding their new thing. And so they're thinking about the model in the way that it used to work and how do we improve it. So I think that new way of thinking, like as I just said, is one way that there might be complementary alignment in how franchisors and franchisees gain that trust together. Funny story. So those guys that I met, so they want to have multi-unit franchisees as investors, right? And so I said, well, we have, we make it our business. We're called franchisee investigators. And so we have compiled information about the ownership of franchisees. And each of them looked at me and they're like, wow, tell me what you got on me. And I was like, happily. So after we exited the conference, I was at the airport and I sent them a little summary about what we know about them. And one guy said, wow, big sister is looking in on us, because we knew that both of them had just sold their houses. We knew that when they started their franchisee business, how many they grew to, who they sold to, their email addresses on how to contact them, who their business partners were, and they were blown away. So I was like, yeah.
Wow.
I like the big sister looking on it instead of big brother.
Has that just been able to get a lot easier for you guys and other data collectors out there to get access to that information? Is it getting harder? Because you look at Facebook, they're kind of cracking down on privacy stuff, but in other ways, there's just seems to be a lot more information that's accessible. So what do you say about that?
It is so hard. It is so hard. Franchisees, I call them the underground club. It's inherent in the franchise model, right? Like, here's a brand, and every store is supposed to look the same. So you have a plaque on the wall that says owned by whatever X Inc. or LLC. So you don't have a face. And I think that's intentional and for good reason. So most databases in the world cannot actually accurately understand who franchisees are. So we try to understand who they are, kind of what significance they have to the system. Are they, a high performer? What's their story? Is this second generation? So we're really getting into the weeds of really understanding. We say, like, we joke, we want to have an FBI file on every franchisor and franchisee.
So let's talk about like how that data can be helpful to the buyers, the franchisees, and the franchisor. Let's start, I guess we'll just go with the journey. There's a buyer. So what kind of information or what kind of helpful things do you see available to franchise buyers that they may not be taken advantage of? Because a lot of buyers, they do the same thing. They get with a broker, they get with a brand, they go through their 6 to 8 week process. And the biggest part of that is validation. And that's where, I think probably is the weakest part of franchise buyers is they don't do enough deep validation with franchisees, and then they make a decision. So that's the typical process. What should they be doing that they're not doing, and how do you guys help?
I love this question because I do have a slightly different vantage. I feel like I have a front row seat to, how franchisors are thinking, and also just like successful franchise systems, what seems to be working. So one tip that I think is a little bit different than what I've heard before is when we look at franchisees and we study franchisees, what I've seen in many systems is that suppliers are actually owners of the franchise business. So what do I mean by that? So one of our customers is Capital One. The guy who was head of SBA at Capital One, he no longer works at Capital One, and he is now a beef jerky experience franchisee. He owns many units. Eric, you became a Soul Salons franchisee. There were lots of other suppliers, people who are in the industry, brokers, who became franchisees. I have many other examples. Actually, one of our employees, we were doing a research project and on discovery days and evaluating the discovery day process between franchisors. And she went on a discovery day and she came back a franchisee. So the reason why I think that's unique is because, and one more thing, in profiles, we see a lot of construction companies becoming franchisees because what do they see as a lender, right? You're seeing the financials of franchisees. As someone who's doing construction, you're seeing the inner workings of how the franchisor works with the franchisee. So they get a visibility into a franchise system unlike anybody else. So I think it would be useful to ask a franchisor by chance, not that it must be, but it's an extra validation point. Like, do you have a supplier in your network? Or do you have someone who used to work at your brand who is now a franchisee? I'm going to the Denny's conference in 2 weeks, and they have many executives from Denny's who are franchisees now. Like, they have a different view on the business that's going to be more meaningful than you can have just looking at an FDD.
Attention, franchisors and franchisees, there are two really important resources that I want to share with you that will help you avoid costly mistakes and increase your enterprise value. The first is our free Facebook group. It's a community that has over 4,000 franchisees and franchisors in it. When somebody asks a question, they get honest and authentic answers from multiple perspectives. You can join the group for free over at franchisesecrets.com/Facebook. The second resource I want to share with you is if you're a franchisor and you're frustrated that you're not awarding as many franchises as you thought you would, this is the reason I created the Franchisor Mastermind. If you want access to the information, the techniques that the best franchise sales organizations are using to award franchises, and you want what mature brands have with their playbook of having happy, successful franchisees that grow the right way, then you might want to check out the Franchisor Mastermind. The reason why people join is they want access to my Rolodex, my connections. They want the playbook to achieve both short-term and long-term success. They want to increase enterprise value in their brand. Links will be in the show notes or at scalablefranchise.com. So that's inside information that's accessible. I was talking to a friend of mine the other day. He's like, Eric, what should I buy? And I'm not a broker. I used to do that. I'm not a consultant. I don't do that anymore. But I'm like, you need to have inside information to make a really good decision on buying a franchise, because it's really hard to fully understand what you're getting into. And even as a consultant or as a broker, I at some point I realized I'm not the perfect magic franchise picker-outer. I just can't pick out the best brands consistently, even though I thought I could, until I realized that I'm not so good at this. And you see that with brokers, consultants, different people. They make recommendations and they think they're really good until a brand does not do so well. Then they realize that they're not as good as they thought they were. But they have access to information that other, buyers don't have. And so that's one of the reasons I purchased Sola, is because I had access to inside information, not illegal information or anything like that, but just inside information. And it really helped me make a decision. There, it was because a lot of the franchisees were friends and family. They followed the founders from their prior business to this business, and they were continuing to grow. And that was an example of kind of some of that inside information. I love it when franchisees are truly expanding. They're opening up another location because they're making money, not because they have to do it or they have a threat of getting terminated or losing some locations or not hitting their development plan and having punishment that way. So that's one of the reasons I love Sola. So anytime you have access to information that the average buyer doesn't, it really helps inform that decision. So I think that's really good. I have
a few more tips for you, Eric.
Please go. I was going to ask for more. So you are reading my mind. Do it. More tips, please.
I love it. Yeah. So this is going to sound a little self-serving, so I will put that out there. So if you ask a franchisor,
don't worry about anything self-serving. Like, you guys have an amazing company, and I think more people need to know about it, especially if they're just new to franchising. So, talk about it very openly on this podcast.
Well, thank you. So if a brand actually licenses their fund score, so a fund score is a franchise credit risk score that is done consistently against all brands. And it gives basically a view on an 8-year success rate, trends in sales, profitability, franchisor-franchisee relationship. So the score is similar to a FICO score. And what that means is if the franchisor licenses the score, then that means the prospective buyer has access to it or knows it. Yeah. And it means that the franchisor has a high success rate, period. They wouldn't license it otherwise. It also means that their access to capital is going to be easier than any other brand, and it's going to be less costly. So what I was told by someone who used to be a banker, who now works for a franchisor, is that his franchisees were getting prime minus, and they were having less post-closing liquidity requirements because they have such a high score. So not every brand can have a high score, And just because a brand doesn't have a high score doesn't mean that there can't be good investments. But that certainly is going to elevate your trust factor in whether you can be successful. Now, for emerging brands, it's a slightly different look. We call it a pre-fund. So it's not a score, but it's like a red, yellow, green, meaning like, are you on the right track? So will you be a brand that's scored in the high category or the less risky categories? So that would be my second.
So at what point does a brand, like if you were to buy a brand, like you would probably have analysis by paralysis or paralysis by analysis, or however you say that. Like, what would you be looking for if you were to buy a brand?
So yes, working for a market research company certainly makes you more conservative if you weren't already that way because you joined a market research company. So I would say that the things I would be looking for, first of all, I would have someone read a franchise agreement for me who's in the industry, both an attorney and just someone who has been a customer. I've looked at thousands of franchise agreements. And recently I did this for my husband's colleague who was leaving the Department of Defense and starting a business. And he was moving to an entirely different state to open up with his wife. And I said, "Are you nuts?" And he said, "No, we believe in this concept." But I read through the franchise agreement. I said, "This is a new brand. I have no idea who their attorney was. But there are a lot of holes in this franchise agreement because it probably was a copy paste. And so you're agreeing to things in the front end that have no applicability to your business. And secondly, are so vague that you want to have definition. So especially when you're talking to an emerging brand, you absolutely want to read that thing with a fine-tooth comb because the franchisor may not even know what junk is in there because they might not have read every single word. And so I think that's critical. Yes.
No, that's an excellent point. Some people think because I'm getting in with an emerging brand, I'm getting a better deal. I'm getting more favorable terms because they are new and they need to sell more or whatever the reason might be. And there might be truth to that. Lower franchise fee, bigger territories. And we see that as we talk to emerging brands. They have territories that are way too big and they're being way too generous with a lot of stuff that will eventually hurt that franchisor. But on the flip side, they are doing things unknowingly that are actually hurting their franchisees. And like you were saying, with these emerging brands, if they are not using a reputable attorney that does FDDs all day long, and they're using somebody that does more copy and paste, they might be putting things in their agreement. I see it all the time. They're putting things in their agreement that hurt both the franchisee and the franchisor, and they don't even know that they're doing it. That was my comment.
To be clear, I don't want people to call me to look through their agreement. That's not what
But you do charge $2,000 an hour, and that's very worth it. So did they not buy? Did they? What's the end of that story? What happened with that particular couple?
They are a franchisee and they're opening up, and so they have a really great relationship. So we'll see how they perform, but they made the big move and they're doing it. And I give them a lot of credit. So, but I think the point was that they sought out counsel first, and we had a couple of hour-long conversations so that they really understand franchising and what they're agreeing to and what they should kind of fight for themselves, especially if they're an emerging brand. They should absolutely fight because they're helping build the brand.
And that's a good point. Just because there were things in there that are like, oh, big red flag here, red flag there, doesn't mean you don't buy. Just because it's an emerging brand or they didn't use this attorney or that attorney doesn't mean it's a reason to buy or not to buy. And the truth of it is, no one will really know until 2 or 3 or 4 or 5 years from now what they're like. Because a lot can change. Even if the brand that is set up for success year 1, they could make some bad decisions year 2, 3, and 4 that really impact the franchisees in a negative way. And I know of some brands that are doing that right now. They have a lot of smart people part of the brand, but they started to make some decisions that really weren't great for the franchisees. And they did it thinking they were actually helping franchisees when it actually turned out to be the thing that all these franchisees are not too happy about right now. All right, let's talk about franchise. Do you have something else on that?
So I wanted to just share that I think it's really important that franchisees should look at the executive experience of the franchisor.
Mm.
So when we first started developing the fund report, we had just launched it. We were starting to just sign up banks, and we had a franchisor call us, and they said, we shared with them their fund score, and it was not good. At the time, I think they had like a 73% historic unit success rate over an 8-year period, very fast growing brand. And the brand basically said, your report does not reflect reality. And so we said, okay, by all means, share with us the information that you have that would contradict what is being shown in this credit score.
Okay, let's play a little game. Let me see if I'm right here. So they said they had more information, and they were going, and your fund score was not truly a reflection of reality. Did they come with a suitcase full of $100 bills and give that to you? Is that what they did? Is that how this whole business works?
So in order to have an improvement in a fund score, if there is information that they have, which there can be, right? So I'm not saying that this isn't possible. So it's what's the difference between perception of what's out in the information that's available in the marketplace, and that the brand might have has not come to light. So they sign up for a service called the Bank Credit Report, which is their way to give us information for us to evaluate and ask questions to see if this is real. On the call with our analysts, the franchisor cancels the project, but doesn't tell the analysts. So he makes the analysts feel like, oh yeah, I'm getting you that information, don't worry. And then he basically asks to cancel the project and wants his money back. Fine. Won't even get on a call with us to explain what happened, right? Did somebody offend you? Didn't someone on my team offend you? So 2 weeks later, I get a call from a bank who has now been a 10-year customer of ours. And they say, we have a fill-in-the-blank storm in our portfolio. We have loans that are failing with X, Y, and Z brands. And guess whose brand it was? And I started laughing. Because I said, you know what? When people question the integrity of the information, it just always gives me such good feeling that what it is actually true, right? So in this instance, the franchisor actually is no longer around. There was a few years later, I think it was 4 years later, they had an action against them by one of the states because they were the way that they were selling franchises, and they had to give money back to their franchisees.
Wow. That's so how do franchisees take advantage of FRANdata? How can current franchisees utilize your company beyond, I think, the helpful reports and surveys that you all put out? And maybe that's it, because as a franchisee, I've been reading those things for years and I love those. And maybe that's it. But is there anything else if they're not ready to buy another brand? Because if they're buying another brand, they should absolutely be, looking at deeper stuff. But franchisees, how do they best utilize your resources?
So we don't have a huge customer base of franchisees. Usually our customers are franchise associations, or we've had regional developer associations.
Let's talk about that.
Usually those are confidential.
No, in general, because I just had Alex, a friend of mine, and he didn't name the brand that he was talking about, but he formed a franchisee association because it was needed. And I knew it wasn't going to be a popular podcast necessarily with franchisors that are afraid of something like that. But there's a lot of work that goes into it, and sometimes it's the best thing for the brand. And I believe it is for this particular brand. So talk about whatever you can talk about franchise associations, franchisees, however you want to go with that.
Yeah. So a lot of times what we're hired for is kind of benchmarking and best practices. So from a broad perspective, it's like just a gut check. Like, is this really what everybody else is doing? Is this really what should be done? And I'd say that that's what franchisors and, franchisee associations would hire us for. It's just, things are changing. Is this in line? So we had a franchisor who wanted to raise their initial franchise fee, and we basically put their proposed new franchise fee on a bell curve to let them understand, for businesses in your category, where would you fall on the bell curve? And the answer was like way at the top. So basically they were going to be amongst the highest cost franchises in their category. Category, I think in that case was like service. It was home service brands. So those are the types of questions that we're asked. Sometimes it's topic specific. So the topics might be something like we've done projects around third-party delivery and royalties, how they're being charged, the commissions are being charged. So sometimes they can be really very granular to a specific industry.
So how does somebody, well, I'm going to ask you this offline, because this is something that I want for us at Front Street, and I don't want to give this away to all the competitors out there. So I'm going to hold that question until the recording stops. Anything else at Springboard that caught your attention, that you thought you had an interesting conversation with somebody, or you just had kind of a macro view of everything? You're like, this is interesting.
So yeah, I mean, inflation, like we talked about earlier, is real, right? And so one of the things is the cost to start up a franchise. And it was last year's IFA, we did an analysis of costs from 2019 to how costs changed in 2021, and by industry. And so I think what we saw, and what I'm hearing from franchisors, is that the candidates that they used to bring to the table for banks to finance are not getting financed. And I think that that's because there's two things going on. One is they're not adjusting to the cost changes, and therefore changing their requirements of what type of franchisee they need to bring in. And then also, how much money will they need for post-closing liquidity? So the candidates they brought in before, who are perfectly qualified and would get financing, are not today, or it's a big challenge to do so. So I think that was a theme that I not only see in the data, but also had experienced in conversations with folks at Springboard.
That's a big thing for you buyers out there, franchise buyers. When you are validating with franchisees of a particular brand, you should find out when they came in, like not just bought the franchise, but when they opened up their first one, their second one, their third one, what kind of price changes they've seen, the all-in costs. Get specific with the building costs and rent costs and all of that. Because if you just ask a question, hey, are you making money and are you happy? And if the answer is yes, and that could be absolutely 100% true, but it might be also true that they came in, before we started experiencing inflation. They don't have bank loans. It's all cash. Or there's so many different things that make that statement true, but would make it not true for you as a buyer, depending on your individual situation. So those are really important things to be aware of. And then inflation in general. Looking at, so I have a real estate project that's a retail project. We spent $200,000 in the last 3 months putting plans together to take it out to bid, and we realized it was going to come in way too expensive. Like, we could not charge enough rent to the tenants, our tenants, to be able to make the project work for us, and so we had to scrap it. We're like, we will wait. And our questions are, where are we in this life cycle of expensive building costs? Why is it expensive? And do we want to be the first ones in the market to charge a really high price for this retail? So there's so many things that I think people need to understand when they're buying a franchise that they might not be thinking about. So inflation and is one of those. And then I think franchisors, one of the things that they should be doing, I'd love to get your opinion on this, is working with lenders, working with banks, working with some of the lending institutions out there that are that know franchising. And if you have a relationship with them, then you know, and then you can really help your franchisees in a better way by having a finger in the pulse of what is actually happening out there with building costs and why banks will lend, won't lend, et cetera, et cetera. So what kind of advice would you have to franchisors out there that might be in a retail concept or some type of concept that is going to be impacted by inflation?
Yeah, first of all, your advice is great, because what we get is emails from lenders saying, good Lord, these costs are skyrocketing. Do the franchisors understand what these franchisees are experiencing? And is this normal? Like, is this the new norm? And so I think there's two things. Is for a franchisor, I had a franchisor reach out to us, probably a year ago and ask, like, how should we set our requirements going forward? And it's all relative to the cost. So if you don't have a handle on the cost and it's changing so much, then there might be reason to pause and kind of digest that, so that you can give guidance as to what is this really going to, what is this going to cost, and then what's the type of candidate that you need to bring into the system to get financing. And then secondly, talking to lenders and saying, what are you going to require? Because there are some levers that lenders can use. So if someone has outside income, they might not require as much post-closing liquidity. So, or if the franchisee has some industry experience or has an operating partner who has industry experience, they might not require as much post-closing liquidity. So there are different things that may change the profile. And I think the better a franchisor understands that, then they won't be sitting with a perfectly qualified candidate, so they think, going through the process and not actually getting to the finish line.
I also think franchisors can look at value engineering the build out. Like, what areas can you save for your franchisees? Just because it's been done one way, and we see this all the time from our perspective, they have really expensive flooring, cabinets, whatever it is, and they don't need to be that expensive for the franchisees. They're not going to lose any customers if some of these products are half the cost. It's been done that way because that's how the franchisor loves really high quality stuff, and now that's passed on to the franchisees, and it's really starting to impact the build out and the cost. The other thing is, like you mentioned it, looking for a different candidate, having a candidate with a higher net worth, more liquidity is a completely different candidate than what they might be used to, but that might be something that they need to kind of shift away from. And that's why some people don't want to have higher franchise fees. They don't want to have, higher fees in general, because they want to attract a lower level candidate for a particular brand. And I don't know if it's just us, and I know some others are doing it as well, but we really want to have an accurate, beefed up item 7 in the FDD that's accurate of cost, but also beefing up the marketing costs and beefing up different things, so it's not just as low as can be. I don't know, in the past, it seemed to me, again, I don't have the view that you do, love your input. In the past, it seemed as you can just strip down as much cost as you can, and it looks like this franchise is going to cost a very little to get into, but in reality, it costs a lot. Now brands are starting to build in more of the accurate costs. Is that true, or is it just me?
So we've seen franchisors who were surprised because from one year to the next, their costs went down, and we're scratch our heads like, how did it go down by that much? And so that's clearly a sign that they're just trying to make it as small as possible to attract the widest audience of candidates, right? The smaller the cost, the more potential people can actually open. The higher the cost, there's just fewer people who have that kind of capital. But I think you're right. In this environment, it has to be more reality, because all that sales time and education time with prospects and the barriers to success are greater in this environment with inflation and with high interest rates. So the barriers to success are higher. So there needs to be more preparedness for the franchisee to be successful.
All right. Last question. Franchisors fail, franchisees fail. There's a bunch of failures out there, and there's all kinds of different numbers. Like you read one report, like 99.9% of small businesses fail within 2.7 years. 90% of franchisees fail or franchisors fail in X period of time. What are some of the real numbers out there? Is there such a thing to get an accurate picture of like regular small businesses or franchisees or franchisors that just don't make it a failure?
So the answer is, first of all, on the franchisor failure, we've actually never studied this. It's really weird. Nobody's paid us to study failure of franchisors. But that's because the definition of failure is a little bit opaque, because if someone is franchising and they convert to licensing, is that a failure? If they are just opportunistically franchising, meaning they just have it on their website, and if someone's interested, then yes, is that a failure? So like the definition of failure is challenging. What I will say is that we do have a report that's called a new concept report, and every quarter we're reporting on every single new brand that comes into our sphere. And in the past year, we had 450 new brands. We were also tracking a different data source that actually gave us a few hundred more brands. So the question of how many new brands are being created, we think is as large as between 800 or 900. So the success of franchisors, I think, is a very different conversation than success of franchisees. Success of franchisees is 100% dependent on the system. We have franchise systems where there's 100% success rate. And then I've looked at franchise systems where there's a 20% success rate. So I don't like to give a success rate across the industry, because it is very different depending upon the business you get involved in.
Okay, that's a very politically correct answer right there, but I buy it. You got me bought into that. So you're saying there's about 800 to 900 new franchise brands that are being that are coming to market in 2023?
So that is based on the information sources that we have 450 that we actually have full set of information on, right? Like, so we know how many units they have, what they're growing, what their pricing is in terms of franchise fees, et cetera. Then we have a set of other brands that we just know exist, but haven't entered into our database. We don't have full information on them, so to speak. So that is our estimate as of today. Don't tell anybody.
I won't. I will only be announcing it shortly. All right. So any last bits of wisdom, anything else that you'd want to leave the audience with?
Yeah, I guess.
Are you speechless? Are you speechless right now?
Well, I feel like it has to be the most.
It has to be the
interesting
best
thing that I've said.
If this is not the best, then I don't know what's going to happen, but probably nothing.
I think franchising is changing. I think franchising is changing, and the reason why I say that is because we're seeing franchisees that come in and go from 0 to 150 units. We see franchisors that are going from 0 to 150 very fast. And so I would just caution us as like an industry that growth is great, but that there are steps that need to be taken to make sure that there's a trusting relationship. And we don't want to lose the dream that is, franchising can help people who otherwise wouldn't be able to be in business by themselves own a business.
That is well said. Edith, thanks for coming on. You were like 10 times better than Daryl, but don't ever tell him, okay? But make sure your whole team knows.
Thanks, Eric.
Thanks for listening to the Franchise Secrets podcast. Links to everything can be found over at franchisesecrets.com. And if you want my help with anything from starting your own franchise to growing your current franchise business, please visit scalablefranchise.com.